Hello traders, welcome back to the Forex Geek where we dive deep into the tool that can help you make smarter trading decisions. And in today's video, we're going to be talking about one of the most powerful yet straightforward strategies in Forex trading. And this strategy is called the moving average trend trading strategy. This approach has been a cornerstone for many successful traders, allowing them to identify and capitalize on trends more effectively. By understanding how to use the moving average, you can enhance your ability to analyze the market movements and make more informed decisions. Whether you are a beginner looking to build a solid foundation or an experienced trader seeking to refine your skills, this video will provide you with a comprehensive guide on how to leverage moving average to boost your trading performance. So stay tuned until the end to learn how to apply this strategy to your own trading and potentially improve your results. We start by understanding what moving averages are. And moving average are a fundamental tool in technical analysis that to helps traders to identify trends and smoothing out fluctuating market price action. They are calculated by averaging the price of a security over a specific period, which can range from a few days a to several months. We have two main types of moving average. The first one is your simple moving average, and we also have your exponential moving average. These are the two main moving averages. The simple moving average, this is the most straightforward type because it is explained as where each day price is given equal weight in its calculation. For example, the 10-day simple moving average would add up the closing price of the last 10 days and divide it by 10. While the exponential moving average, which is unlike the simple moving average, the exponential moving average gives more weight to recent prices, making it more responsive to recent market movements. Now, this makes it particularly useful for traders who want to react quickly to changes in the market. Now, I'll show you the difference between these indicators. The two, the two simple moving averages are on my screen. Let me change the color of the EMA. I'll make the EMA yellow so that we would not be confused. Now, let's make it red. The EMA would be red, while the simple moving average would be blue. And we'll set it to 10 period. Let's use 10 period for the EMA and 10 period for the simple moving average. Okay, this is basically what it is. You can see often traders use specific moving average to analyze trends and make trading decisions. The common periods they use is 10, 20, 50, 100, 200 days period. They can be used individually or in combination to provide all and most comprehensive view of the market trend. Remember that we said the simple moving average is a combination of the last the addition of the last 10 days, the closing price of the last 10 days and dividing it by 10. That's for a 10 period moving average. While the EMA is giving more weight to the recent price movements. That means it is quicker to respond compared to the simple moving average. And as you can see at this area in the market, if you can look at this area in the market, the blue line indicates the simple moving average, and as you can see, when price traded to the upside, spiked to the upside before coming back down, It was only the red line, which is the EMA, that responded to that movement because it gives more weight to the most recent price movement, while the EMA, the simple moving average, is usually the division of the last 10 days, using the previous 10 days data to predict what price will do in the future. Now, there are some key signals that we need to know, like the moving average can also generate important signals when they cross each other. For instance, when you are using a short term moving average and a longer term moving average, this is known as a golden cross. Now, let's use an example of, for the simple moving average, let's use the simple moving average. If we are using 10 simple moving average and 50 moving average, when we see a crossover, it usually signals that the trend is about to change. This is basically what it means. And as you can see at this area, when the moving average, the 10 crossed over, the yellow line is the 50 period moving average. So when the 10 crossed below the 50 moving average, you can see price change the direction at this area. And as you can see in this area, when it crossed over, you can see that price still changed direction. So this is a key signal that you need to keep in mind. These are the things that we need to know about the moving average. This is known as the golden cross. Conversely, when the shorter term moving average, which is when the blue line crosses below the longer term moving average, that's the 50 moving average, it is called a death cross. Golden cross is when it crosses above, death cross is when it crosses below the longer term moving average. So let's see how we can apply this to our trading strategy. We first start by setting up our charts, and we set up our charts by using our, let's use the 5 period moving average. We'll use the 5 period moving average, and we'll use the 20 period moving average. You can also use the 50 period moving average. So let's use this. The setup would allow us to view the market from multiple time frames, helping you identify trends and potential trading opportunities. The 5 period SMA, that's the 5 period simple moving average, reacts quickly to price changes, while the 20 period moving average provides a balance between responsiveness and stability. The 50 period moving average often serves as the long term perspective of the trend. Now, the second step we'll look at will be to identify the trend. We'll use the moving average to identify the trend of the market. If price is above all three moving average, it indicates an uptrend. So let's add our let's add our moving average. Let's add 20 moving average. Let's none. Let's add 20. When price is above or below all three moving average, it signals, if it is above all moving average, it signals a buying opportunity, which is uptrend. While when price is below all three moving averages, it signifies a selling opportunity. This is something you should also keep in mind. This step is crucial for determining whether you should be focused on a long or a short position. Now, how do we enter? How do we enter? To enter your trade, you would have to look for a crossover between the short-term moving average and the long-term moving average. These crossovers can provide strong signals for entering the trade. Now, for a buy signal, when you notice that price is trading above the moving average, you have to wait when you have to see the short-term moving average cross above the long-term moving average. You can check when price, like we are using three moving average, we are using the 20, we are using the 5 period, the 20 period and the 50 period. The 5 period is this blue line, the 20 is the red line and the 50 is the yellow line. So the moment we notice that price has crossed over the short term moving average, the blue line has crossed over this moving average, the 20 and the 50 moving average, this signals a buying opportunity. When you see a crossover, this will be the perfect period for you to enter your long position. Now for a selling trade, when you see the short term moving average, which is the 5 period moving average, cross below the 20 and the 50 moving average at this area, this will be a good period for you to enter a short position. Now the fourth step, and is a very important step, is risk management. Once you have entered a trade, it's essential to manage your risks effectively by setting a stop loss order to limit po ten tial losses if the trade doesn't move in your favor. For long term trade, you can place your stop loss just below your 20 period moving average. That will be above. In a buy scenario, just set it below the 20 period. Remember, our red line is the 20 period. This would be a perfect place to set our stop loss just below the 20 period moving average. In a selling position, you set it just above the 20 period moving average. This provides a buffer against short-term fluctuations while still allowing the trade to breathe. For short trades, you can set your stop loss above the 20 period EMA. As the trade becomes more profitable, consider adjusting your stop loss to break even to protect your gains. This ensures that if the market reverses, you wouldn't incur any losses. The step 5 would be to monitor and adjust your trade. You have to always continuously monitor the relationship between this moving average. Meaning when you indicate another crossover between this moving average, this will signify price might be willing to change direction. And as you can see at this area, that there was a crossover, price was signaling maybe there will be a reversal at this area. Even this selling opportunity at this place, when there was a crossover, you can see at this point that there were a lot of crossover. This would have signified that the market was going to move in a sideways direction until it crossed over here and moved to the up direction. You can see at this area the same thing. This was a crossover for a sell trade until price got here and made a lot of crossovers, signifying that we need to leave a trade. So the moment we enter a trade and we sight another crossover while the trade is moving in our direction, this can be an opportunity to sit on your hands and leave the position and secure the possible profits you can secure. All right, traders, we have come to the end of this video. Engage with us in the comments below. We want to hear about your experiences. And if you found this video helpful, do not forget to like, share, and subscribe. Turn on your notification bell so that you wouldn't miss out on more trading tips and strategies. Thank you for watching, and I will see you in the next video.